Right. So today we're going to keep talking about some basics, and there's a few fundamental points I really want to drive home. My main strategy is selling puts. From that, I sometimes end up owning the stock and then I sell covered calls. So I think it's vital to understand why I like to sell. Like when we talked about the mountain, um, when a put goes down the mountain 1 mile, it increases in value. But when a stock goes up the mountain, the put decreases in value. So selling puts is a bullish move. So what I look for when I am selling puts is either to sell the put when the stock is at a bottom of a trend or trending sideways. So they're kind of the philosophies. But what I want to do is dive into what makes up a stock option so that you can then understand why selling them is is such a strong strategy. So options, they're really just ways to get into a stock without having to buy the whole stock. So like Tesla is trading at $440. If you wanted to get in and just profit, not invest, but profit off the movement, when Tesla's down, you can buy an option for $50. When Tesla goes up, your option goes from 50 to 55 and you just made $5. Um, so instead of having to invest 450 a share, you invest $50 a share. So it's a cheaper way to get involved truly on the price action. That's why this is not investing. This is trading. Your goal is not to own the options forever. The goal is to get in, make money, and get out. So, since buying things is so hard to make money, I like to sell things because I'm guaranteed to make money when I sell it. Now, it can go against me. You can lose. There's always risk. And if you end up owning the stock, it can go down or go down to zero. But you will bring in money no matter what. So, what is a stock option? It's the right, but not the obligation to buy or sell a stock at the agreed upon price and a date, puts and calls. Um, so, what does that mean? So, there's a strike price, there's a date, there's time, and there's a delta. So the first thing is that there's a premium. Like does this stock have value? So you're going to pay a premium to purchase this option. And then there's strike prices. Some are once a month. That would be the third Friday of the month, or they're once a week. Daily options, different things. I'm not going to get into that, but every Friday at the close of the market, so every Friday at 4 p.m., would be the end of your options. So if you bought it Monday, your strike price, it correlates to this week, Friday's expiration. If you buy it Monday, a week from then, the next Monday, it has no value. It's gone. So how do they work? So here, yeah, the right but not the obligation to buy or sell a stock at a predetermined price before a set expiration date. Puts and calls. Do you think it's going to go up, go down? Um, you need to have authorization with your broker to be allowed to sell them, and there's different levels. We can get into that later. These are not employee stock options, what I'm talking about. And they are sold in contract, which is made up of the right to get 100 shares. So one contract equals 100 shares. So if the option is $1, it's actually $100 because the contract is 100. One contract equals 100 shares. So it's $1 per share inside your contract. And I can break that down more in the future if need be. But just remember, one contract controls 100 shares. I like to sell sometimes 5, 10, or even 50 contracts to really maximize your profit. Um, but the key parameters. So you have an expiration date. It is what it is. It expires on Friday. So if you're doing a stock option that is good until January 30th, that's it. January 30th at 4 p.m., that option is over. So that is its expiration date. You can go out days, months, weeks, years, but it expires on Friday of that date at 4. That's it. Um, the strike price, that is what it is. If you think Tesla is going to hit $460 and you pick that strike price, there is a premium that correlates to it. And I'm going to show you that later. But the strike price is where you think the stock will be on that expiration date. Strike price is very important selling puts. I'm going to dig into that later. And then contract size. One contract is equal to 100 shares. So you can sell multiple contracts. If you buy 5, you then control 500 shares. And then there's the premium. The premium is the price paid for an option. It's determined by taking the price of the call, multiplying it by the number of contracts, then multiplying it by 100. So if the premium is $1 and you do 10 contracts, so it's 1 times 10 times 100. That's how much you have invested. So here they say $1 per contract. You bought 100 the IBM 150 call, the January, buys 5 of them for $1. You'd spend $500 because it's 5 contracts. Each contract is worth 100 times 5 is 500. If you think it's going to go up, let's just say it goes to 300 and your contract goes from $1 to 2, you've just doubled your money. You've only invested 500 instead of whatever this would be, $7,500. So it's a way to leverage your money. What is part of the premium is there's a time value and the delta. So I'm going to pull up the whiteboard to jump into what the time value is and the delta, just so you can understand. And again, a lot of my focus is selling. So on selling puts, why the premium, the delta, and the time value are such an ingenious way for you to make money. I'm going to try to break it down real simple. So okay. So before I pop up the whiteboard, I want us just to pick a premium, to pick a stock and discuss the premium. So what I'm going to look at is Opendoor. It's trading at $6.57 now. Okay. We're going to go out a little bit longer than a week just for this example. So I picked options. Here are my strike prices. So the stock is trading just around 650. So what I want to look at is Friday, January 30th, the put. So we got strike price, $6.50, expiration date, premium, 28 cents. So 0.28 times 100 is $28 per contract. All right. So we're just going to talk about the $28 per contract. And if we had sold 10 contracts, it would be $280. So we want to talk about this number here, 28. What is made up of that? So I'm going to talk about the premium, the time, the delta, and why selling this and time is on your side versus buying it and time is against you. All right. So remember that when you sell, time is on your side. Okay. So the stock is open. This is our expiration. So it's going to expire Friday, January 30th, 4 p.m. No questions asked. 650 strike price. Okay. The stock is trading right around 650 now. Okay. So what is our goal here? Our goal is to cash flow our account. So if we have, just to keep the math simple, $7,000 in our account, we can do 10 contracts because one contract would be $650 because we're controlling 100 shares. 10 contracts would be 1,000, so it's $6,500. Okay. 28 per contract is $280 off of our account size of 6,500. And in the future, I'm going to get a better drawing tool. But as everyone who's listening to this, if anyone does, these are all my practice beginning. So you have an account size of 6,500 and you're going to make $280 next week. So that's pretty good. This is going to take $6,500 and make $1,000 a month. I don't know any of anything that powerful other than the stock market. But yes, it's at risk. We're not even going to dive into that because you have to understand it's at risk. If you can't tolerate that this could become zero, you shouldn't be doing this. If you only have $6,500, you shouldn't be doing this. This is when you decide, hey, I want to create a part-time income. So I have a business. I'm going to invest $6,500 in my business, and I'm going to give it a few years to see if I can get this to be, unlimited, where I can make, $3,000 a month, $5,000 a month, whatever your goal is, without having to open a storefront, etc. So, all right, this is why selling puts is so awesome. You've sold these puts. You don't own the stock. You've just sold it. If Opendoor closes above 650 on Friday, you keep the premium. That's the end of the conversation. If this closes at $7, you just made 280 bucks. If it closes at $77, you made 280 bucks. Now, what goes into that premium? And this is what I like. So we talked about the delta and time. So part of this is this has a value of 1 week, but it's going to expire. What happens if you looked at food? If you baked a cake on Monday, I wonder if there's a cake picture in here. I don't know if there is, but in the future, I'll have a cake picture. When will that cake have the most value? Obviously, when it comes right out of the freaking oven. When does the cake have the least amount of value? Right? When it's been sitting around for a week. All right. So we just baked this cake. It comes right out of the oven. It's worth $280 to us. If this cake, the stock, just rolls like this and basically goes sideways, and this is $6.50 here, there is a time element to this option. Okay. So the further out you go, if we were to sell the 650 out 2 weeks, it probably would be worth 50 cents. Why? Because there's more risk. So you are taking a longer risk associated with the time and that stock strike price. As the stock moves, as time goes on, that value evaporates like the quality of the pie. So if you sold it for $28, and let's just say that's Monday, by Wednesday, and it just went sideways, it stays within, let's say right here is 660, and this is, I don't know, 690. It's just trading in that range. Well, does it have more or less value a week into it? It will have less value because a lot of these are set up for people to buy them. Again, buying is a really risky way because if it doesn't go your way, you've lost money. If you sell it, it goes sideways or up, you make 100% of the premium. Now, if you sell a strike price that's farther away from where it trades, the stock can go sideways, up, and even down a little bit, and you'll make money. But for this example, we're trading it right around the strike price, right around like at the money, they call it. So what we want this stock to do is go sideways or up by Wednesday, Thursday, Friday. If this stock is at 655, this premium will go from 28 cents to, let's say, 5 cents. So you sold it at 28, right? That's a 23-cent difference. You could buy this back for a nickel and close it out, and you just made $230. All right. What the heck did I just say? It's a transaction going opposite, right? You sold it for 0.28. The value equals a nickel. What's the difference? 23 cents. So you sell to open, then you buy to close, which is a BTC for a nickel, sold for 28. You're going to buy to close for a nickel. 23 or $230. Transaction is closed, and that's your gross profit minus your commissions. Okay. So that's the premium of time. If the time has a 20-cent value in this 28-cent option for a week, as time uh, uh, as time goes on, or it erodes that value, right? If it's 5 cents a day worth of value, and just as time goes on, 5 times 5 is 25. You've pulled out your nickel a day. That works to your advantage versus if you bought it and it didn't go down. If you bought it and it went sideways, the time is eroding. You can't buy it for 28 and then as it devalues, sell it for a nickel and make money. It's the opposite. So we sell to open, buy to close, or we just let it expire. So I hope that makes sense, but that's why we sell puts. Now, the one last thing, I wonder if I can just move this off the screen. There's a thing called a delta. So let's put the delta in here. Oops. Let's say the delta is 50. What is that? It's real simple. So if you have 50 delta, that means if the stock moves $1, the option moves at half that. So the stock moves $1, the delta is 50, the stock moves 50, or the option, excuse me, moves 50 cents. Okay? So if you have a delta of 50. If you have a delta of 10, stock moves a dollar, option moves a dime. Now, I don't dig into this too much, but that's what I call the meat on the bone. You really want, that's why you want a volatile stock. But um, when you have a stock that basically barely moves, a lot of these traditionals, I bet you if I looked up Ford or these stocks that have been around forever, they have really low deltas, barely any premium. You might buy it for $1. It has a fractional delta. The stock will go up $10 and the option will go to $1.10. It's not worth trading. That's not what we're looking for. So that's why it increases the risk. But there are cases, if you have enough in your account, a low delta name brand stock where you can just cash flow smaller amounts of money, if that makes sense, because time is evaporating. So the delta, the riskier the stock, the better the delta. But the premium and time, they're your friend. You want a stock that's at the bottom, moving sideways or going up, that has a nice premium, and that time will just evaporate. And that will evaporate that premium to your advantage when you're a seller. So I hope this makes sense. Um, Again, practicing, learning. We're all going to learn this together. Um, and I'm just going to continue to dig in. Um, Hopefully it makes sense. Any input on how to do it better, explain it better, what makes sense, um, will be greatly appreciated. Thanks.